I made my fortune by being wrong. Let me explain what I mean by that. Most people in finance spend their entire careers trying to be right. They analyze data, build models, and convince themselves they've found certainty in an uncertain world. I took a different approach. I assumed I was always wrong, and I built my entire investment philosophy around that assumption. My name is George Soros, and over 5 decades, I turned a small hedge fund into one of the most successful investment vehicles in history. But here's what most people misunderstand. My success wasn't about being smarter than everyone else. It was about thinking about risk in a fundamentally different way. Today, I want to share with you how I actually think about risk, not the sanitized version you read in textbooks, but the real framework that guided every major decision I made. People often ask me, how did you know to bet against the British pound? Or how did you predict the 1987 crash? The truth is, I didn't know anything with certainty. What I understood was something more valuable. I understood the nature of risk itself. Let me give you some context. When I started in finance in the 1950s, the dominant theory was something called the efficient market hypothesis. This theory suggested that markets always reflect all available information, that prices are always right, and that it's impossible to consistently beat the market. Most investors operated under this assumption. I saw things differently. I developed what I call the theory of reflexivity, the idea that markets aren't just passive reflections of reality, but active participants that shape reality. This insight changed everything about how I approached risk. For those new to finance, when investors talk about risk, they usually mean the chance of losing money, but that's too simple. Real risk is about the gap between your perception of reality and reality itself, and that gap. That's where fortunes are made and lost. What I'm about to share with you isn't just theory. These are the actual principles I used to generate returns of over 30% annually for nearly 3 decades. These are the frameworks that guided me through the 1992 British pound crisis, the Asian financial crisis, and countless other market upheavals. Let me start with my most counterintuitive principle. I always assume I'm wrong. This sounds strange, doesn't it? How can you make confident investment decisions if you assume you're wrong? But that's precisely the point. The moment you believe you're certainly right, you stop paying attention to signals that contradict your thesis. You become rigid, and rigidity in markets is deadly. I developed what I call a hypothesis testing approach to investing. Every investment is a hypothesis about how the world works. I enter a position not because I'm certain, but because I have a testable idea. Then I watch carefully to see if reality confirms or denies my hypothesis. Here's how this worked in practice. When I analyzed the British pound in 1992, I didn't say I know the pound will collapse. Instead, I said I believe the pound is vulnerable because the UK is trying to maintain an exchange rate that's incompatible with its economic fundamentals. Let me test this hypothesis with a small position. The key was staying flexible. As evidence accumulated that my hypothesis was correct as the Bank of England struggled to defend the pound, as political pressure mounted, I increased my position. But I was always ready to exit if I was wrong. This approach to risk means I'm never married to a position. I'm married to the process of discovering truth, and that process requires accepting that I might be wrong at any moment. What I did next with this philosophy surprised even me. Now let me explain reflexivity, because this is where my thinking really diverges from conventional wisdom. Traditional finance assumes a one-way relationship. Reality determines market prices. A company's fundamentals determine its stock price. Economic conditions determine currency values. Simple, right? But I observed something different. Markets don't just respond to reality, they help create it. There's a two-way feedback loop. Let me give you a concrete example. In a real estate boom, rising prices make people more willing to lend and borrow. This increased lending drives prices even higher. Higher prices create the illusion of reduced risk, which encourages even more lending. The market's perception is actually changing the underlying reality. This works in reverse too. In a panic, falling prices make lenders tighten credit. Tighter credit forces more selling. More selling drives prices lower. The market's fear becomes self-fulfilling. This is reflexivity, and understanding it changes everything about risk assessment. When I analyzed risk, I wasn't just looking at fundamental values. I was looking for situations where this reflexive loop was either building to unsustainable levels or about to reverse. These inflection points where perception and reality are most misaligned, these are where the biggest opportunities exist. The 1992 pound situation was a perfect example of reflexivity in action. The UK had joined the European exchange rate mechanism, promising to maintain the pound within a specific range against other European currencies. But their economic fundamentals, high unemployment, recession, were pulling in one direction, while their currency commitment pulled in another. I saw a reflexive trap. The more the Bank of England raised interest rates to defend the pound, the more they damaged their already weak economy. The worse the economy got, the less sustainable the pound's value became. It was a doom loop, and I positioned myself accordingly. But here's the crucial point about risk. I didn't need to be certain this would happen. I just needed to understand that if it happened, my potential profit was enormous, and if I was wrong, my losses would be limited and manageable. Understanding this asymmetry leads me to my next principle. Most people think about risk symmetrically. They imagine that if they can make 10%, they can also lose 10%, equal upside, equal downside. I think about risk asymmetrically. I look for situations where I can make several times my money if I'm right, but lose only a fraction if I'm wrong. This asymmetry is everything. Let me break this down with the pound trade again. When I built my position betting against the pound in 1992, here's how I thought about the risk. If I was wrong, if the UK successfully defended the pound, I would lose my option premiums and some money on my positions. Painful, yes, but manageable. Maybe a 5% loss on the capital I allocated. But if I was right, if the pound broke from the exchange rate mechanism, the profit potential was enormous. We're talking 100% returns, or more on the capital deployed. This is asymmetric risk, limited downside, massive upside, and this asymmetry is what allowed me to size the position aggressively. It wasn't reckless gambling. It was calculated risk-taking based on asymmetric payoffs. I see many investors make the mistake of taking symmetric or even negatively asymmetric bets. They chase small gains while exposing themselves to catastrophic losses. They pick up pennies in front of steamrollers, as the saying goes. My approach was the opposite. Risk substantial amounts only when the potential reward vastly exceeds the potential loss, and stay small when the payoff structure doesn't favor you. This leads to another crucial question. How do I actually know when I've found that asymmetry? Throughout my career, I've observed that markets move in what I call boom-bust sequences. Understanding these sequences was critical to my risk management. A boom-bust sequence has several stages. First, there's a trend in reality, maybe a new technology or changing economic conditions. Second, markets recognize this trend but then overinterpret it, creating a gap between perception and reality. Third, this gap gets reinforced through reflexivity, creating increasingly unstable conditions. Finally, reality reasserts itself, often violently. The key to managing risk is identifying where you are in this sequence. Early in a boom, risk is actually lower than it appears. Yes, you might be wrong about the trend, but you have time to recognize your error and adjust. The market hasn't yet built up excessive leverage or unrealistic expectations. Late in a boom, risk is much higher than it appears. Everyone feels smart because prices keep rising, but you're sitting on a powder keg. The reflexive loop has created massive instability, and any trigger can cause collapse. I made my fortune by identifying these late-stage boom situations where perception had diverged dramatically from reality, where leverage was high, and where the system had become fragile. The British pound in 1992 was exactly such a situation. The exchange rate mechanism had created an artificial stability. Everyone assumed the pound would hold, but beneath that calm surface, tensions were building. The economic fundamentals couldn't support the currency level. It was a late-stage boom in confidence, ready to bust. When I found these situations, I didn't think this will definitely collapse tomorrow. I thought this is unstable. When it goes, it will go hard. I want to be positioned for that. This is very different from traditional risk management, which focuses on volatility and correlation matrices. I focused on instability and inflection points, but identifying these opportunities is only half the battle. The other half is something most people completely misunderstand about how I operate. Here's a truth that makes people uncomfortable. Having the right idea isn't enough. You need to bet big enough for it to matter. Many investors get the direction right but size their positions so conservatively that even when they're correct, it barely moves the needle. This isn't prudent risk management, it's a waste of insight. When I had conviction when I'd identified an asymmetric opportunity with favorable risk-reward, I sized my positions to make a real difference. The pound trade. I committed $10 billion. That wasn't recklessness. That was conviction combined with favorable asymmetry. But here's the nuance that people miss. I only sized aggressively when multiple conditions aligned. Asymmetric payoff structure, clear hypothesis that could be tested, evidence accumulating in my favor, ability to exit if I was wrong without all four conditions. I stayed cautious. But when they aligned, hesitation was the real risk. The risk wasn't betting big, the risk was betting too small and missing the opportunity. This requires something beyond analysis. It requires courage, not blind courage, but the courage that comes from having a robust framework for thinking about risk. When you truly understand the risk structure of a situation, sizing appropriately becomes logical rather than emotional. Let me distill what I've shared into practical lessons about risk that anyone can apply. First lesson, embrace fallibility. The investors who fail are the ones who convince themselves they have certainty. The moment you think you can't be wrong, you stop learning. I built my entire career on the assumption that I'm always wrong somewhere, and my job is to find out where before the market does. This kept me humble and adaptive. Second lesson, look for asymmetry. Don't take risks just because there's potential reward. Take risks when the potential reward vastly exceeds the potential loss. This principle alone will transform your relationship with risk. Most opportunities in life and markets are not asymmetric. Don't waste resources on symmetric bets. Third lesson, understand reflexivity. Whether you're investing, building a business, or making career decisions, remember that perception and reality influence each other. Markets, organizations, and social systems all have reflexive properties. The most fragile situations are those where positive feedback loops have created a large gap between perception and reality. Fourth lesson, test your hypotheses. Don't commit fully based on theory. Enter positions small, watch how reality responds, and adjust accordingly. This isn't hedging your bets, it's scientific method applied to risk-taking. You're gathering evidence, not making prophecies. Fifth lesson, size matters. When you've identified a genuine, asymmetric opportunity, have the courage to make it meaningful. Half-hearted commitment to good ideas is a form of risk itself, the risk of insignificance. Let me pose a question to you. What would you do in my situation? Imagine you're analyzing the British pound in 1992. You see the economic fundamentals don't support the currency level. You see political pressure building. You see the Bank of England caught between defending the pound and supporting the economy. But you also know that governments can be irrational longer than you can stay. Solvent, you know that betting against a major currency is dangerous. You know your reputation is on the line. How much would you bet? How would you structure the risk? Would you have the courage to commit billions when everyone else is saying you're crazy? These are the real questions of risk management, not abstract calculations, but concrete decisions under uncertainty with real consequences. The final lesson is perhaps the most important. Risk management isn't about avoiding risk. It's about understanding risk well enough to take the right risks at the right time in the right size. The greatest risk in investing and in life is not taking enough risk when the opportunity is genuinely favorable. I want to hear your thoughts on this. Do you think my approach to risk, assuming fallibility, seeking asymmetry, understanding reflexivity, applies beyond financial markets? Can you use these principles in your career, your business decisions, your personal life? Comment below with your perspective. Tell me about a time when you identified an asymmetric opportunity, or share a situation where you're currently trying to assess risk, and let's think through it together.